Hello everyone, welcome back to Boss Economics World, where we break down the hot issues in economics, on point, with a dash of satire for good measure. Now, buckle up, because this week's episode is all about how the UK government managed to unravel the already fragile economic scenario with their latest budget, sending inflation concerns right back into the spotlight. And, surprise surprise, the Bank of England, BOE, is left holding the pieces, cornered between rising debt, bond market chaos, and an anxious public hoping for some relief in interest rates. So let's talk about what's really happening here, and how all this ties into the bigger picture of Britain's economic management. First up, let's dive into the why behind this market panic. Just when we thought inflation might be on track to cool down, the UK government threw a heat bomb into the mix, a huge fiscal boost at a time when the economy really didn't need more fire. Chancellor Reeves unveiled a fiscal package that raised government spending by a staggering £70 billion per year on average. Now, this money's supposed to go into public services and investments like infrastructure, awesome in principle, right? Well, not so fast. The problem lies in the fact that Reeves' grand fiscal plans are only partially covered by tax hikes. In reality, more than half of the spending is being financed by borrowing, which economists have repeatedly warned will only add more fuel to inflation. And honestly, you couldn't pick a worse time to douse the economy with borrowed money. Inflation was already a massive headache for the UK, and this move has basically turned up the heat when what we needed was a cool down. The Bank of England had been signaling that inflationary pressures were softening, especially with services prices slowing down, giving us hope for successive rate cuts. But Reeves' budget gambit has thrown a wrench into those expectations, leaving us all wondering if the BOE will have to hit pause on those desperately awaited rate cuts. Now, let's talk about the financial markets because, boy, did things get ugly fast. As soon as Reeves made her announcement, UK bonds, gilts, went into a tailspin, with the yield on 10-year gilts soaring to 4.45%, a staggering 21 basis points rise over just 5 days. The short-dated 2-year gilts weren't immune either, seeing a rise of 27 basis points. It's the sharpest spike we've seen since January, and given the context, it's giving everyone flashbacks of the infamous Liz Truss mini-budget crisis of 2022, where her £45 billion package of unfunded tax cuts sent the bond market in a tailspin. Here's the kicker, though, while the fallout from Reeves' budget isn't quite as catastrophic as what happened under Truss, the parallels are unsettling. Investors are clearly fearful that the BOE will have no choice but to keep interest rates elevated or take a slower path to easing, which would push up the costs of borrowing for everyone from the government down to individual mortgage holders. And that's not something any of us want to see after over a year of tightening financial conditions. Indeed, Mark Dowding of RBC Bluebay Asset Management put it bluntly, we struggle to build much of a bullish narrative. Why? Because this fiscal blowout comes at a time when global financial markets are already jittery, with central banks from the US Federal Reserve to the European Central Bank keeping a hawkish stance on inflation. If anything, the UK is now behind the curve, and that's where investors have serious concerns. Let's address the elephant in the room. Will the Bank of England cut rates this week, or will they hold back? Economists were certain the Monetary Policy Committee would go ahead with a second rate cut this year, bringing the bank rate down by 0.25 percentage points to 4.75%. However, with the fiscal loosening, markets have rapidly reversed course. Now there's less than a 20% chance of a second rate cut in December, a far cry from the multiple cuts that were once on the table. So what's the argument here? Well, before Reeves' fiscal bombshell, inflation appeared to be below target, and for the BOE, that meant it finally had breathing room to start cutting rates. Services, a key inflation input, were slowing down, giving credence to the narrative that inflation would soon fall closer to the 2% goal. Even Andrew Bailey, the governor of the Bank of England, had signaled that the BOE might even be a bit more aggressive with easing once inflation data showed significant cooling. But now, the MPC faces a major communication challenge. How should they position this rate decision amid rising inflation risks exacerbated by the government's budget? If they proceed with the cut, it could be viewed as underestimating inflationary pressures, particularly with bond market yields spiking. If they hold steady and delay further cuts, they risk dragging the UK economy down, prolonging a higher cost of living for households across the country. This is no easy decision, and the timing couldn't be worse with the US elections and global dynamics playing in the background. We can't forget that the world still looks at the BOE as one of the premier institutions guiding economic management, and any perception of dithering or miscalculation could send ripples through the global economic system. What makes this conundrum particularly precarious for the UK is the fact that other major central banks, like the US Federal Reserve and the European Central Bank, are decisively ahead in their monetary cycles. Both are facing similar inflation challenges, particularly with energy price volatility and geopolitical tensions continuing to put upward pressure on prices. However, let's look at what's happening stateside for a moment. The Federal Reserve, often a bellwether for where global central bank policy is heading, has indicated it may be close to the end of its tightening cycle. Yet, unlike the BOE, many observers aren't expecting the Fed to rush into rate cuts anytime soon. That means the BOE, given its new inflationary concerns, may have no choice but to stick with a higher-for-longer approach to interest rates, especially if the pound remains under pressure. The European Central Bank is a similar story. While inflation in the Eurozone has shown signs of easing, the lingering effects from energy prices and fiscal policies in EU member states means inflation isn't completely tamed. Christine Lagarde has remained cautious, and the ECB has not yet signaled a definite pivot toward rate cuts, which creates further complexity for the BOE. In this context, it becomes crystal clear, if the UK tries to ease too quickly, when other central banks are keeping their fingers on the trigger, the pound could weaken further, exacerbating inflation through higher import costs. And once again, the middle-class consumers will feel the brunt of these choices in their food bills, energy costs, and mortgages. So, what are the bigger implications if the BOE missteps here? For starters, if inflation expectations aren't managed correctly, Britain could face stagflation, a toxic economic cocktail of low growth and persistent inflation. We've seen it before in the 1970s, where the combination of supply chain disruptions, sluggish growth, and cushioning inflation led to a lost decade for the UK. With many already questioning the long-term growth prospects for the British economy after Brexit, further mismanagement could cement the UK as a laggard in the global economic race. But beyond these long-term fears, there's the more immediate question of living standards and income disparities. While nominal wages are rising, they're still not outpacing inflation, leaving households squeezed. Living standards are projected to grow only marginally this parliamentary term, worsened by debt-financed government budgets that aggravate inflation. It's a cruel irony that, despite all the political promises of levelling up, the UK is sliding backward on economic equity. Moreover, the next generation of Britons could face crippling debt burdens. Government borrowing must eventually be serviced, and with interest rates higher than what the government anticipated even a few months ago, debt costs could skyrocket. This doesn't just push pressure forward, it shifts it downward, hitting future taxpayers and limiting their ability to invest in housing, education, and retirement. In sum, the UK finds itself wounded by misfired fiscal strategies and an overreaching central bank that must now clean up the mess. The Bank of England must thread the needle between tackling inflation and cushioning an economy already bruised by years of mismanagement, from Brexit to COVID, through endless political drama. If the BOE cannot strike the delicate balance needed now, then the UK is heading into a longer-term economic crisis, complete with rising inequality, stagnation, and inflation, an economic stagflationary quagmire, no less. The pound could sink deeper. Investor confidence could wane. And once again, Britons will be poorer for it. Hold on tight, folks. The next few months are going to be crucial for Britain's economic fate.